This is an essay called Mortgage Madness, Bailout Bullshit, Part 1, The Meaning of Money. In a modern economy, people basically engage in economic activities. They work, they earn, and they do this to produce things that they cannot themselves consume. You have to do something that somebody else wants and will pay for. But if you're a construction worker, that might mean mixing cement. It might mean doing something with the plumbing of a new building. It might mean something having to do with wiring. It may have to do with keeping track of the costs in the construction process. None of these things can you consume. If you mix cement, you can't take that home. You can't eat it. You can't use it. You did something as part of a process that's going to end up producing something that somebody wants, and they want it enough that they're willing to pay for it. The person who buys the building or the company that purchases a shopping center or an office building is doing something that they think is productive. That is, they're going to use it for an economically productive activity. They're going to sell things, lease out space to retailers, or a medical building will lease out space to doctors. And in these cases, they can't take it home either. So, in a modern economy, people do small bits of things that when you put it together will produce something productive. And we know it's productive because somebody else who's working and earning is using those earnings to buy it. So in an economy like that, where you're selling and buying from people you don't know, maybe widely separated in space, and in fact you might be using equipment that was designed by somebody who's dead. So in effect, this equipment is productive and exists because somebody produced something in the past but is no longer alive. This continuity over time and the connection across large distances can only occur if you have some kind of standardized mechanism of exchange. The standardized IOU that's used is called money. It's used for transactions because it means the same thing to the person receiving it and the person giving it. It's a way that you can be rewarded for something that you've done that's a benefit to someone else in the economic sphere. And they are rewarding you by giving you money, which you can then go out and buy whatever you want. You don't have to buy something from the person that you produce something for. Money gives you that freedom, and it is a source of trust. So, do you trust somebody in another country to send you something? Or if you send them something, that you'll get something back for it? Well, if there's an exchange in one direction of goods and services, there's an exchange in the other direction of an IOU. And the standardized IOU is called money. Now, if someone in our economy, in the U.S. economy, or any modern economy, works and earns and wants to save, saving means you did something that was valuable to somebody else, they gave you an IOU, they gave you money, but you don't want to use it now. You want to buy something sometime in the future, maybe a long time in the future. So you have to take this IOU, you have to trust it to be able to be stored and to be translated into something you really want in the future. Now, all of this network of trust is something that has to be maintained, or there's a good chance people will stop working. Or if they do work, they also try to game the system by outsmarting people who don't know that this store of value will be no good in the future. So, what do you do if you put money in a 401k, or you take savings and you put it into a CD at a bank? Well, let's say what you get is an IOU. You give them money, they give you an IOU, and the IOU says, for this savings account, for this CD, you will get 3% return. And when the duration is over, then you will get your principal back. Then you're saying, okay, I have a right to go out and buy a car, but I don't need a car. I've got a car. Or I don't have a car and I don't need one. So they take the money, let's say $20,000, and they lend it out. Now, there's something out there to be purchased. You produce something and you didn't consume anything. So there's $20,000 worth of goodies out there that somebody is going to buy. Now let's say the bank has a customer, someone who operates taxis, purchases a $20,000 automobile to operate as a taxi. Let's assume that the taxi driver has customers, and that the demand for riding in taxis is increasing, and so maybe the person is purchasing a second taxi and hires somebody to operate. So what you've got is a loan to buy an automobile, the automobile you didn't want, with your savings, that is what you had a right to buy because of what you produced. And the taxi owner then operates the taxi. So you're getting 3%, the bank lends it out at 8%, they get $1,600 per year. The taxi driver, after all expenses, makes $3,000 on the taxi per year. So the taxi driver keeps $1,400 profit, pays $1,600 interest. The bank pays you $600, 3% of $20,000, and the bank keeps the difference, which is 5% or $1,000. And the bank has employees and has a building and has operating expenses, and also sometimes makes bad loans. If almost all of the loans are good, but some are bad, then some of that profit, some of the profit they make on the good loans, covers the losses on the bad loan. So when they decide, instead of you, when they decide to who to lend to, this is underwriting, and this is the end of part 1.